going to have to take the Fed at their word that they're going to be doing the rate hikes. 7 hikes is what they said they're going to do. They've done 1 already, so it's 6. And if you calculate out, they were actually forecasting potentially 11 hikes. Whether or not that's going to be the real case or not is a whole other discussion. So, all right, I don't want to keep anyone held up anymore. If anyone happens to, oh, it says scroll for older comments? Oh, I see. All right, let's get started here. Anyone who comes in late, I guess I'll have to rewatch the video. So first and foremost, if you're new to me, my name is Justin Pulitzer. I do trading videos, and I'm a trader. I've been a trader for about 25 years. I'm starting to look at my face in this video, and I'm like, I look a lot older than the last time I did one of these. Oh, man. Anyhow, I have a lot of market experience. I've been pretty accurate over the years with my analysis on the Fed, sometimes a little eerily accurate even for myself with discussing what I think they will and won't do. And I'm going to go through my notes here. A lot of the time what I say becomes consensus in the coming days. I'm very early on this. I kind of specialize in the Fed these days. I never really thought I would. I took a kind of college course back in the day that was a survey course on monetary policy in the Fed, and it was pretty good. I mean, I have to tell you, a lot of the stuff I take from this is from that class, and just years of trading and my experience with the Fed. So, so let's get through it. So as we know, the Fed today raised interest rates 1/4 point. The target rate is 25 to 50 bips. They're going to do ongoing increases of the Fed funds rate. I think Powell was very mindful today of not saying the word autopilot, because if he would have said that word, I think we would have been down for the count. And the market was able to recover a little bit after the initial plunge on the Fed. And I don't want to kid anyone. Today's Fed was very hawkish. The statement was hawkish. The minutes, or whatever, the pre-release statement was hawkish. Powell's comments were hawkish. The Q&A was hawkish. There was nothing that was said today that was not hawkish. It was all hawk all the time. There were a couple of little things that I think people were trying to hold on to say that they weren't hawkish, but I'm going to present them to you as why I think they were hawkish. So they're going to do the ongoing increases. He said that they're going to do balance sheet adjustments in a coming meeting. So he didn't say when that meeting is going to be. He kind of made it sound like they could go next meeting, but if they were going to go next meeting, why didn't he just say next meeting? So I'm thinking what they're going to do in the next meeting is lay out what those balance sheet adjustments are going to be, and then they're going to go in the meeting after that. So I think we have a little bit more of a grace period before they start tinkering with the balance sheet, which is probably a good thing. So he did say that they're going to do 7 increases in 2022, so that would be 6 more, taking the rate up to 1.88%, and then they're going to do 5 more in the next, 2 years, between 23 and 24, taking rates up to 2.8%. And as I had noted in my concerns before going into the meeting, would the Fed take rates past the neutral rate, which has been about 2.5%? I think Leisman today was saying it was 2.4, and my understanding has been 2.5%, but we're talking about 0.1 here or there. So that would be the point where the Fed views interest rates as deleterious to the economy, where it would be beyond that would take down growth. So that's concerning because if the Fed is now looking to calm an already slowing economy. So they talked about the inflation rate is 4.3%. That's up 1.7% from the last read, which is a gigantic move. They talked, and now we're getting in. That was just the initial statement. Now we're getting into the Powell presser. So he did, again, I mentioned the balance sheet reduction at an upcoming meeting. I wish he would have given some more clarity on that, but this is where the Fed loves to live, in ambiguity in these instances where they want to have fungible room. So that was a little bit more positive. He said Omicron slowed growth. We all know that. His comments about Ukraine were, to me, that the Fed is looking past it, that it's not being factored in right now. I think that they would view that as transitory. Whether that'll prove to be the case or not, it's a little worrisome. But he did talk about, the labor market being tight, 3.8% unemployment. He was talking about the low end and minority, like lower end jobs and minorities. I guess he equates that with them. I guess you could start making comments about that, but we won't go there for the time being. And interest rates are improving. He talked about fast wage growth, which is always something to concern because that's what the Fed really does watch, whether they want to admit it or not. They're worried about that because that's obviously, if you've ever run a business, and I've run several, and my biggest increase at the end of the year, or I should say biggest expense at the end of the year, whenever I reconciled my books, was always labor costs. Whatever, paying staff and paying out, so on and so forth, always was the biggest expense. High energy inflation, he talked about that. The good news is it is starting to come down, and we may have a peak in oil. That's, obviously we're in a fluid situation and things could change very quickly, particularly if things heated up with Iran, or maybe if things go really much worse with Russia, that could be problematic. But it seems to me that oil may have peaked for the time being. And if you look at the last 2 years, and we had talked about this, remember what I said at the end of last year was going to be my Q1 trade for what I had told people I thought would be the buy, and I said it was for the last 2 years the same? Energy. It turned out to be much bigger than I thought it would be. If you would have asked me in December when we talked about this, I wouldn't have said I think oil gets to $130. I could tell you that. I did think Exxon would recover. That was my big play. We had talked about that and a few others. And Enbridge is one I like. And there, I don't want to get too into it, but there were some others, Schlumberger and so on and so forth. And that was just because traders have recency bias and they do what works until it doesn't. In the last 2 years, it had worked as a Q1 trade, and here it worked again. Oddly enough, we're at a point now where everyone is bullish on energy, right? I get so many questions about oil stocks and so on and so forth, and Cramer's all bulled up, right, about energy, but it's peaked in March the last couple of years, so it's very possible we're seeing the high watermark for energy at the moment. That's still to be determined. Again, a more fluid situation. We didn't have a hot shooting war in Europe with the Russians, in the last couple of years, but that is what we have now. Remember I coined the phrase, which got very popular a few years ago, the lower for longer. I'm going to have to come up with something witty now because he said it's going to take longer than expected to get back to price stability. So maybe just longer than expected. That to me is the reverse of lower for longer, and it means increasing rates for longer. So again, more hawkish. He said that inflation risk is to the upside. And when he talked about, I heard a lot of TV anchors today. I always watch to see what they say because it's usually incorrect. But, once in a while they get it, and I'll give them credit when it's due. But a lot of people were saying there was flexibility and maybe the Fed was going to do less hikes. I think the risk, and I hate to say it, is more. If inflation risk is to the upside, their flexibility to me is more. So I'm just assuming that for the moment. I'll let you know if that changes. Obviously, economic data has been slowing. I had posted the chart earlier if you want to go back on Twitter, and I had posted both the September and the current economic outlook from the Fed. And back in September, they were seeing change in real GDP. They were looking at a projection for 2022, they were looking at 3.8%, and their June projection had been 3.3%, and now they're down to 2.2%. And it keeps dropping. The 2023 numbers were supposed to be 2.5 and 2.4, now they're down to 2, and then the long run rate is the 1.8%. So I hate to say it, but we're back into the new norm of the Obama-Biden economy. So we're back into that stall speed type of growth. And when you're running at stall speed type of growth, the risk for recession is very high. And the problem I have is that when you look at the 2s and 10s, the yield curve, it's very close. When you start getting within a half a point or a quarter of a point, it starts getting to be high risk. And we're right in that kind of sweet spot now where it's not a foregone conclusion of recession, but we're there. I mean, we're really, really close. And I'll say, even if we don't get the 2 quarters of back-to-back of negative growth, it may feel that way if you're in a 1.8% growth economy or a 2% economy and inflation is running at 4%. I mean, we're technically there already with inflation outpacing growth. So if you want to adjust growth and you want to adjust the economy for inflation, we're already in a recession. So, no one you won't get that from people on TV, but I don't have to worry about that kind of stuff. I just tell you the truth. So that's where things are at. And if you go to the pump and you fill up your car, last year I filled up my tank. It cost me $38. The other day it was $63. I live in New York City. I drive. Having a car in the city is a privilege. Most people don't, but it adds up. And I'm just saying. And 64% of the U.S. population lives paycheck to paycheck. And if they're factoring in more for energy, they have less than they're spending on other things. And you got to factor in also heating and cooling costs for their homes. We got a little bit of a break in the Northeast now. We've had a bit of a warmer patch, so you haven't had to use heat as much. And I guess if you want to keep the windows open a little bit, you don't have to use the AC as much. So there's a little bit of a break there. So that's a little bit of a saving grace. Again, I mentioned the inflation risk was to the upside. Progress on he talked about the progress on the securities policy, and he said he's going to be mindful of market conditions with the balance sheet. And again, I think the market took that as that they are willing to kind of back off based on how things are going with growth. But again, I come back to, are they going to do it faster? I think the risk is to the upside with them doing it quicker than expected based on inflation data. So I'm hoping that the Fed clarifies that. I'm hoping the market was right about that today, that maybe I'm wrong on it, but I don't think I am. He said they're going to be nimble on upcoming data risks, so we'll see. He said the American economy is very strong. I just made you the case. I just read for you their own numbers. If Jay Powell wants to say that he thinks GDP, at 2.8% for this year is really strong, and it's going down to 2% in the next 2 years, that's really strong. And the Fed's forecasts have never been that great. Now we get to the Q&A, which to me was I thought really terrible. He said that jobs data is key, but I think that the way he answered the question, the Fed is mindful of jobs numbers, but they're kind of where they want them to be, and they're now inflation fighters. That's what the Fed is doing. And then he talked about higher commodities weighing on GDP. Again, I think we may have peaked in that cycle. We're seeing some pretty large declines in commodities, so that they may get a little bit of help in that regard. Here's the other thing. Would the Fed consider doing faster hikes? Would they do, because he said that this time is going to be faster, meaning that I guess they're not going to go, they used to, when the Fed was hiking in 2018, they were going a quarter point or so every 3 meetings, quarterly. So now I guess it's going to be every meeting, but I was wondering, and I don't know that this is to be, again, correct or not, will they start doing half a point increases if they need to, if inflation really starts picking up? So that to me is a risk. I didn't think they were going to go half a point. Even when the market had it priced in, I told you guys, when it was like a lock and everyone thought it was crazy, I said there's no way they're going a half a point their first time, because if they went a half a point today, then we have to assume the next meeting's a half a point and a half a point and a half a point, and then they could definitely hike us into a recession very quickly. So maybe they'll just hike us into a recession this time a little bit more gently, which is always seems to be what the Fed does. I would have explicitly liked the Fed or Powell today to have said, we're going to try not to break the economy and we're not going to hike the economy into recession. If he would have said those words, I'd have been a little bit more comforted, but we didn't get that. We definitely didn't get that today. And I'll talk about why I think the market rallied towards the end of the day and, how that has set up, and I was positioned for it correctly and all that. So one point, let's see. He was talking about the tight labor market, 1.7 job openings for every one person seeking employment. And so he says it's a tight labor market. Yeah, until the economy starts slowing and people start getting fired. So, we have, again, I mentioned this, if inflation is high and job wages are going higher, what does that promote? more automation and more AI. And if you have you been to Whole Foods lately? Have you been to McDonald's lately? Have you been to anywhere where there's checkout? Bed Bath and Beyond, there are no checkout people. It's very rare. Maybe there's one or two working, but the rest is all automated, self-checkout. And that's just going to keep increasing as technology gets more and more advanced and as wages go, higher and higher. The cost of implementing that technology becomes cheaper. And the big risk, of course, is going to be when trucking, which is one of the highest paid jobs, is automated. Once that happens, that's going to be unbelievable. So he talked about this, that the Fed and this to me was what got me really nervous. They talked about slowing demand to give supply time to recover. This is one of those be careful what you wish for, and I have to tell you, this is again where the Fed exposes themselves as Keynesian economic acolytes, where they talk about, adjusting demand, and they don't really worry so much about supply. But I think that we obviously had a supply shock, and anyone who talks about supply side economics being antiquated and incorrect, the famous was calling Reagan's economic policies voodoo economics. But clearly here we need a bolstering of supply. Maybe doing something with the gas tax would be an immediate relief, but maybe pushing for more domestic production of energy and natural resources so we're not as dependent on countries like Russia and China and Venezuela and Iran and people, who want to destroy our ways of life and paying them for it. I mean, it's kind of crazy. He talks about the balance sheet. He talked about the balance sheet right off, and he said even it could happen as soon as next meeting. I think that they're testing the water. I think the Fed would love to start that next meeting. I don't know that they will, though. We're gonna have to see. That to me is still a bit of a wild card, and I guess we're gonna get some signaling out of these chatterbox Fed governors in the next couple days, whether they're for it or not, and we'll start looking and seeing what they say. But it seems to me, I'll assume it's live, but I tend to think that they're going to announce the plan for that next meeting and then not start it immediately. That's what they should do. What they will do is a whole other conversation. He talks about bringing inflation back down to sustain economic growth. So I guess that's the nod that they're not going to try to hike the economy into recession. Now, I looked at a couple of things today. It didn't surprise me that the VIX came in a little bit, and it didn't surprise me that the market rallied a little bit. The market had gotten down to the range low. We rallied yesterday, which was Tuesday, and then today, Wednesday, into the Fed. When you rally into the Fed, the chances for at least an immediate rug pull, a trader's rug pull, is high, and we got it immediately. But the market was able to recover once the gap filled from Tuesday's close, which was, I actually think, good technically. But we set up here wondering if the rally today is going to continue or not, and the answer, I think, will be a little bit... it's a little bit of a mixed message here from me on that. Often we'll have moves on the Fed either up or down that reverse the next day. So if we don't reverse tomorrow, meaning Thursday, the probability is we start rallying up higher into Friday's quad witching expiration, which is the next big hurdle that we have to get through. We have a quad witch. I think the reason also the market rallied a lot today was people were loaded up with so many puts, so much put protection from the last few days. Sentiment had gotten crazy poor. We had talked about that. Although, oddly enough, in my survey that I do, my proprietary survey, we were up big as far as sentiment goes into this Fed meeting. We had been at 38% at the weekend, and we jumped up to 49%. Now, granted, it wasn't an overbought condition where we were like, mid 55s or 60, but the rate of change of 11 points in the bulls coming directly from the bears, and I'm looking, it was 38, 53.9 to 49, 41.10. So that was a direct flip, was enough that I think that that's what caused that rug pull. And I had talked about this with a few DM subscribers that I thought that we would get the rug pull and the opportunity to reload. And then I used the rally, oddly enough, into the close to book a lot of profits on some short put spreads and so on and so forth that I had on in the anticipation of lower volatility after the event. Usually, unless you get some kind of major shock, and the Fed isn't in the business these days for major shocks, you get what everyone was worried about, that they bought the protection for, then they take off. So I think that's what happened with the volatility crush toward the end of the day, and that with the the increasing prices was what kind of got me out of some of my positions. And I was also looking for a gap fill. I had mentioned this the other day. I want to just pull this up to make sure I have the date right. Why isn't this toss is so finicky? We have a gap fill here from 3.3, and that was at 435.71, and we got just close to there. So that's why I used the opportunity to book some profits. Now, let's talk about the charts here. I'm going to talk quickly about the S&P and then the Qs. And if you're a DM subscriber, I'm going to send out an email tonight with my a little bit of a write-up on this conversation and some trigger levels for option plays. But I think I usually say that we could use the Fed day range as a gauge pretty much on, I wouldn't say everything individual stock-wise, but you could do it for S&P, Qs, TLT, GLD, things like that, macro type of economic indicators, not so much, is XYZ stock going to be up or not. Although you can use it for that to some degree as well, but I tend to use it more on the more macro tools. So I was looking at the chart today, and we do have a trend break in the SPY. NASDAQ is right up to the trend. It's like maybe a hair above the level. I mean, if I have the dog in my lap the whole time, my leg's falling asleep, I got to put this guy down. But we do have a trend break in the S&P, and we did get the gap fill. So that's a bullish pattern if it can hold. Now, I was looking at a couple of levels here that I think are key. First and foremost is the high of day of 435.68. Obviously, anything above that remains bullish. I think the market could pull back, like if we get a liquidation break, let's say Thursday, that you could try buying the dip at the 20 MA at 429.76. I think that would be a check back to the downtrend line, and if that were to hold and rally, you could use that as a launch point for longs. Anything below that level, though, gets a little bit iffy for me because it would be below today's VWAP, which is 431.84. You might want to write these levels down, and that to me is the key. That like VWAP and that 20 MA is the must hold. Now, anything below there to me I'll view as more bearish, and obviously anything below today's low of day of 424.80 is much more bearish. In the NASDAQ, it's a little bit different. I was looking at the Qs. I was using SPY, by the way, for that. If I hadn't specified, I think I did. But the NASDAQ is still in the downtrend, and it has a downtrend within the down channel. So today we did close above the 20 MA, which has been some resistance, so that is bullish. But we closed, I'm just looking at it now, I mean, it's just like the little part of the candle is peaking above the downtrend line. So I'll just say we're at trend. Now, there's a couple of key levels, if you follow me for a while, that I think are important. The first and foremost being 338.19, which we did close above. The 20 MA also is right just below there at 336.87. So as long as that narrow band holds, I think it's bullish. I think if we start getting back below 334.15 and 330.51, it starts getting more bearish. That being the January low from the spike low from 124, and then the 10 MA being at 330.51, which has been the resistance. So if that can act as support, then I think it's still okay, but anything below there to me gets much more bearish, and of course if we lost the low of day of 328.40, to me it would get much more bearish. So that's my take on the market. I think that we have a bit of a mixed bag. We know that we have a very, very hawkish Fed. All accounts here, the statement, the Q&A, and Powell's prepared remarks were all hawkish, all three across the board, 3 for 3. So it's a question now for me of money management. Are we going to stay strong into the end of the quarter? Is it just going to be to, kind of squeeze some people out for the OPEX that's coming up, which I'm expecting a lot of volatility into on Friday? Usually those OPEX tend to have negative bias. It would be interesting if this one wound up having some positive bias, and I think we could see, I am expecting a Q1 markup. I don't know if it's going to be like the last day or two of the month like they did it with February, but the performance for money managers was so poor in Q1. I'm thinking that there's a chase for performance into the end of the quarter. And then I think there's a real risk of a much larger decline in the market potentially coming, the sell in May go away. And we go into that kind of window period between earnings where companies can't do, they don't do the buybacks, they don't comment. And we have a lot of headline risk. And then there's, the April 15th tax payments. So after the quarter, there's a couple of weeks there where things could be a little bit iffy. And then I think we'll get some real resolution post that. And then, of course, the sell in May go away, we have to worry about. But we're going to take it inch by inch and take it from level to level. I think that's the easiest thing. I think a lot of people have notions and ideas, and those are all fine and dandy, but, seeing is believing, and we'll go by the proof in that regard. So I think we'll wrap up the video there. I'm going to see if I can save this. If anyone has any insight on saving these, because I didn't see it save into the usually it saves into the camera roll. It didn't. So if anyone has some ideas about that, please DM me. I'm going to try and back it out. I may just do a screen record if it didn't save. So I hope you enjoyed the video. I'm sure it's going to be available for playback at least here. I'm going to try and get it up on my Vimeo and YouTube channels. And I'm going to get cracking now on my chart version of the midweek video. If you're not subscribed, or if you want to buy it a la carte, it'll be available on my Vimeo page. The link to that is in the description in my Twitter profile. I hope that answered questions. If you have any, feel free to DM me if it's about the video, and I'll do my best to get back to you with a quick response. Cheers.